the quietest power grab in commodities. A single financial institution now holds 750 million ounces of silver. Let that number land for a moment. That is not a small hedge. That is not a casual allocation. That is a position large enough to influence an entire global market. For 15 years, this institution accumulated silver while most investors were told to ignore it. According to the data in this document, the stockpile grew from less than 5 million ounces in 2012 to 50 million in 2015, then 150 million in 2019, 500 million in 2024, and finally 750 million ounces by January 2026. In just the last 6 weeks alone, 21 million ounces were added. Pause there. Global annual mine production is about 830 million ounces. That means one private bank now controls nearly a full year of worldwide supply. The COMEX exchange reportedly has only 32 million ounces available for delivery. This single entity holds 23 times that amount. The London market, the LBMA, sits around 790 million ounces total. One bank is almost equal to the entire London market. And here's where the story shifts. In 2020, that same institution paid a $920 million fine for precious metals manipulation, the largest fine ever paid by a bank for that category. Yet after the fine, accumulation did not stop. It accelerated. This is not about rumor, it is about positioning. Between June and October of 2025, they closed a 200 million ounce short position. For the first time in 15 years, they are no longer betting on lower prices. They are fully long silver. That changes everything. When an institution holds 750 million ounces, every $1 increase in silver translates into 750 million in value. If silver moves $100 higher, that's $75 billion. If it moves $200, that's $150 billion. At $600, roughly the inflation-adjusted high from 1980, the position would be worth $450 billion. This is not a casual trade. So the real question becomes, why now? Why accumulate for 15 years, suppress volatility, and then flip long at this exact moment? Because something in the structure of the market is changing. And to understand that shift, we need to look at how the silver system actually works and where the cracks are starting to form. The paper illusion no one talks about. Most people think silver trades based on supply and demand. In reality, it trades on contracts, promises, and there are far more promises than there is actual metal. Right now, paper claims on COMEX total 760 million ounces. Actual silver available for delivery, just 32 million ounces. That's a 24-to-1 ratio. 24 paper ounces for every 1 real ounce. That system works until it doesn't. Normally, traders buy futures contracts for price exposure. They roll them forward. They rarely ask for physical delivery. The machine depends on that behavior, but according to the source material, that pattern is shifting. In the first 2 weeks of January alone, 33 million ounces were removed from COMEX vaults. That's 26% of available inventory gone in 7 trading days. On January 7th, 8.1 million ounces were delivered, and 99% of that came from one institution. Everyone else combined delivered just 1%. Think about what that implies. If delivery requests rise while inventories fall, pressure builds. And when pressure builds in a fractional system, stress spreads quickly. Now reset your focus. There's another signal flashing red: lease rates. In normal conditions, borrowing physical silver costs 1 to 2% annually. In October 2025, lease rates spiked to 35%. Even now, they sit around 7 to 8%, well above historical norms. That's not comfort. That's tightness. And then there's the price disconnect. COMEX quotes silver at $16, the paper benchmark. But physical markets tell a different story. In Dubai, silver trades between $165 and $170. In Japan, $140 to $150. In Shanghai, $135 to $140. That's a $40 to $70 gap over the official price. In some cases, buyers are paying nearly 60% more for real metal than the screen price suggests. In a healthy market, arbitrage closes that gap. Traders would buy at $16, take delivery, sell at $170, and capture the difference. But if delivery isn't easily accessible, the arbitrage breaks. And when arbitrage breaks, price discovery fractures. This matters to you because markets don't usually advertise their stress. They whisper it through technical imbalances first: rising lease rates, inventory drains, delivery surges, price gaps. And while that stress builds, the largest silver holder in history has already flipped fully long. The surface looks calm, the structure underneath is shifting. And the squeeze isn't only coming from inside the exchange, it's coming from the other side of the world too. The global supply choke point. While Western markets wrestle with paper versus physical tension, another force is tightening the vice. And it began on January 1st, 2026. China implemented strict new export controls on silver. The metal is now treated similarly to rare earth elements, categorized as strategically sensitive. Only 44 companies in the entire country are permitted to export silver, and each shipment requires government approval. That's not a minor policy tweak, that's a structural shift. China refines 65 to 70% of the world's silver. Before these restrictions, over 4,000 tons per year were exported to global markets. Now, according to the source material, that flow is being restricted. Silver is being retained domestically. Why would they do that? Because China isn't just refining silver. It consumes massive quantities internally. Solar panels, electric vehicles, electronics manufacturing, data infrastructure. China leads global production in several of these sectors, and every one of them requires silver. Attention reset. This is not about geopolitics alone. It's about industrial necessity. By 2030, solar demand alone is projected to require over 12,000 tons of silver annually. Electric vehicle production is expected to reach 50 million units per year by 2030, each using more silver than traditional vehicles. 5G networks require silver in every base station. AI infrastructure requires vast data centers filled with servers, and each server uses silver in its circuitry. That demand didn't exist at this scale 5 years ago. It barely existed 2 years ago. Now it's accelerating. Meanwhile, 70 to 80% of silver production comes as a byproduct of mining other metals like copper, zinc, and lead. Only about 20% comes from primary silver mines. That means supply cannot easily ramp up in response to price. Even if prices explode, new mines take 7 to 10 years to develop. So picture this. On one side, industrial demand is climbing sharply. On another side, China, responsible for refining most global supply, is restricting exports. And layered on top of that, one US bank holds 750 million ounces and has just shifted fully long. That is pressure from multiple directions. And there's one more development that adds another layer. In November 2025, silver was added to the US critical minerals list. The government officially recognized it as strategically important, placing it in the same category as rare earths. That designation didn't happen randomly. When strategic classification meets tightening supply and record private accumulation, markets tend to reprice. But before assuming straight-line outcomes, we need to examine something history teaches clearly. What happens when silver surges too fast? And whether this time is actually different. The ghost of 1980, and why this isn't the same setup. Whenever silver starts gaining momentum, one story resurfaces: the Hunt brothers. In 1979, Nelson and William Hunt accumulated roughly 200 million ounces of silver. Prices moved from $6 to nearly $50. Then the rules changed. Exchanges restricted buying. Margin calls hit. The Hunts were leveraged. They couldn't meet the demands. The system snapped back. Silver crashed. The lesson most people absorbed was simple: you can't corner silver. But look closer. The Hunts were using borrowed money. They relied on leverage. When exchanges altered margin requirements, the structure beneath them collapsed. Their position was powerful but fragile. Now compare that with today's numbers: 750 million ounces versus 200 million. That's 3.75 times larger than the Hunt position at its peak. And according to the document, this accumulation was physical metal, not leveraged futures contracts. That distinction matters You cannot issue a margin call on metal that is fully owned. You cannot force liquidation of unleveraged physical inventory the same way you can with derivatives. Attention reset. This doesn't mean history can't rhyme. Governments can intervene, rules can shift. Trading restrictions can appear, those risks are real. But the structural vulnerability that broke the hunts may not apply the same way here. Now consider the math. In 1980, when the gold-to-silver ratio compressed to 15-1 during the bull market peak, silver dramatically outperformed. Today, gold is around 5,100 while silver sits near 106. That places the ratio around 46-1. Historically, bull markets have seen that ratio fall toward 15-1. If gold remained at current levels and the ratio returned to 15-1, silver would be 327. If gold moved to 6,000 and the ratio hit 20-1, silver would be $300. If gold reached 10,000 in a currency crisis and the ratio compressed again to 15-1, silver would calculate to 667. These are mathematical scenarios based on historical ratios, not predictions. But here's what matters for you. Large institutions run these same calculations before building decade-long positions. They evaluate downside risk. They model volatility. They assess intervention scenarios, and after 15 years of accumulation, they closed 200 million ounces of shorts between June and October 2025 and flipped fully long. That timing suggests confidence. Still, no thesis is bulletproof. Recession could reduce industrial demand, governments could impose restrictions, high prices could incentivize substitution research. New mines could eventually emerge, though development timelines remain 7 to 10 years. So the real question isn't whether silver can move, it's whether the structure underneath can withstand what may come next. And to answer that, we need to zoom out and examine how wealth transfers actually unfold over time. The wealth shift. Most people miss major wealth transfers rarely feel dramatic at the beginning. They feel boring, technical, easy to ignore. Then one day, everyone realizes the repricing already happened. Real estate in the early 2000s, tech through the 2010s, crypto during specific cycles. The pattern is familiar: early positioning, structural tension building quietly, then a rapid expansion phase. Silver may be approaching a similar inflection. Let's connect the full picture. A single institution controls 750 million ounces, nearly 1 year of global mine supply at 830 million ounces annually. They accumulated for 15 years, expanded from less than 5 million ounces in 2012 to 750 million by January 2026, and in the last 6 weeks alone added 21 million ounces. They paid a $920 million fine in 2020 related to metals manipulation, yet continued accumulating. Then, between June and October 2025, they closed a 200 million ounce short position and flipped fully long. At the same time, COMEX holds 760 million ounces in paper claims, backed by only 32 million ounces available for delivery, a 24-1 ratio. In early January, 33 million ounces exited vaults in 7 trading days. Lease rates that normally sit at 1-2% spiked to 35% in October 2025 and remain elevated at 7-8%. Physical silver trades at substantial premiums internationally, with markets in Dubai, Japan, and Shanghai pricing real metal well above the paper benchmark. Meanwhile, China, refining 65-70% of global silver, restricted exports on January 1, 2026, limiting shipments to 44 approved companies. In November 2025, the US designated silver as a critical mineral. Layer industrial growth on top of that, projected 50 million electric vehicles per year by 2030, over 12,000 tons of solar demand by 2030, expanding 5G networks, AI-driven data center buildouts. And remember, 70-80% of silver supply comes as a byproduct of other mining operations, meaning rapid supply expansion is unlikely. New mines require 7 to 10 years. Now reset your perspective. You don't need silver at $800 for this to matter. You don't need extreme forecasts. What matters is positioning relative to structural shifts. There are generally 3 responses to moments like this. Some people observe and do nothing. Some overreact and overleverage, and some study the data carefully, manage risk, and think in multi-year cycles. No one can make that decision for you. This is not financial advice. It's a structural breakdown of what the largest players appear to be doing. 10 years from now, this period will be easy to interpret. In real time, it feels uncertain. That's how transitions always feel. If this analysis sharpened your perspective, engage with it. Share your view. Subscribe if you want deeper breakdowns of how major institutions position before markets move. Because the biggest shifts don't announce themselves loudly. They accumulate quietly until they don't.